Money and metals. Well, the big news last week was Fed Chief Yellen and the conference she held after the Federal Open Market Committee. Basically, I had two takeaways. One, that the unemployment rate is looking better and better, according to Janet. And secondly, that the inflation rate will remain low. What I find interesting was the dollar flash crash that happened. And this, of course, is showing by the market extreme volatility. In currency news, the euro is on track for the best week it's had since October 2011. The dollar set its worst week in about 2 months against the franc and the yen. The dollar's positive bias remains intact for the most part, and overall the commodity currencies rose against the dollar. The dollar fell last Friday, on track to its worst weekly performance in more than 2 years against the euro, undermined by expectations that U.S. interest rates will rise much slower than expected. Still, despite the dollar's weakness, market participants believe its decline is temporary, and the U.S. currency needed to pull away from the steep gains that it has had over the last 6 months. In what seems to be the first signs of cracks appearing in what has been a united front among most major banks, HSBC on Thursday last week raised its euro forecast to 120 by the end of 2016, arguing that the dollar's explosive rally was nearing its end. The commodity currencies were on a roll versus the US dollar, with the Australian dollar up over 1%. The New Zealand dollar was up almost 2%, and the US dollar was off about 1% against the Canadian currency. On the gold front this week, precious metals, both gold and silver, were near 2-week highs and set the biggest weekly gain since January. Gold is still getting traction from the dovishly perceived FOMC statement, short covering and fresh purchases. And so we look at gold globally, looking at South Africa, some of the lowest valuations in decades are hitting the South African miners. This portends acquisitions in the future. In other gold news, the new London Bullion Market Association gold price went live for the first time last Friday, with Goldman Sachs and UBS joining the 4 members of the now defunct Gold Fix in setting its electronic replacement. Goldman and UBS joined Barclays, HSBC, Bank of Nova Scotia, and Societe Generale to set the new benchmark for the gold price, administered by the ICE Benchmark Administration at 10:30 GMT on Friday, March 20th. Now that the old gold fix is out of the way and this new mechanism has taken place, it will be interesting to see if any changes are perceivable or not. That remains to be determined. And in silver news, silver may bottom this year with meaningful gains next year, according to the consultancy group called Metals Focus. Their forecast is that the prospects for the gold price over this period suggest that the gold-silver ratio will remain around the 70 to 75 level for the remainder of 2015. However, they do see silver outpacing gold in 2016. My view is a little more bullish than that. I expect to see the silver-gold ratio narrow maybe late in the year, but starting in September at the latest. Time will tell. And that's a wrap for this week in Money and Metals.